Time now for On the Radar, where we ask an investing professional what they're looking at in today's markets. For more, we're back with Lewenza, Senior VP and Portfolio Manager at Turner Investments, Raymond James. Why do you believe the Fed is getting very, very close to a pause? You say the Fed may stop next month. Does that mean raise next month and then stop?
Correct.
Right.
So one more 25 basis point hike, and then we could be done. I cite three important factors. Number one is mission accomplished. The economy is slowing. That's what they're trying to do. So I can point to the ISM manufacturing. U.S. manufacturing is in contraction mode. We have a deeply inverted yield curve. And then we also have the old leading economic indicator, which I think we may pull up here.
Let's bring that up now.
Perfect. So what this is a great indicator. Clearly, I'm a nerdy economist if I love certain statistics. So this is a composite that looks at a bunch of different leading economic indicators, puts it into one. And right now it's at -7. And you can see that this is consistent with historical recessions, right? Go back to the 2008, go back to the 2000 level. So this is, again, consistent with a recession, it's consistent with a slowdown. So number one, the economy's slowing. Number two, so is inflation, right? Inflation month in, month out has been declining. We had a peak of 9% headline inflation last summer. We're now down to 5%. Right? It is trending lower. And then the third factor that I think is going to come into the calculus for the Fed is this little mini banking crisis. Okay, so what's going to happen is the banks are going to start to tighten credit standards. They're going to lend less now as a result. And that, in fact, is a de facto rate hike. So for those three factors, I think at the next Fed meeting, which is in May, they're all going to be discussing this. They're going to hike by 25, and then they're going to move to the sideline, just like the Bank of Canada did not too long ago.
Do you think they'll signal that they're moving to the sideline, or that they're willing to pause if, depending on the flow of data, as did the Bank of Canada?
If I was a betting man, I think that they're going to say we are now moving to the sidelines for these factors. Now, they'll couch it. They'll say if we start to see a reacceleration of inflation in the economy, we will then in turn start to tighten. Okay, but I think this will be I think it could be the one. If I'm wrong, I may be wrong by one meeting, but I think that this is a big one. And I should add, at the last meeting, they basically suggested suggested that they're getting close. So for all these reasons, I think we're close, which has been the most dominant macro headwind that the economy and markets have faced for the last 12, 18 months.
And speaking of that, let's bring up another graph that you brought to us. This one shows the relationship between interest rates and the S&P 500, I believe,
Yes.
correct? So I think we've mislabeled those lines. One of them is the S&P 500, correct?
Yeah, so
that's
that
the forward PE multiple on the S&P 500 is which line there, right?
So the blue line is the PE ratio for the S&P 500. The white line is U.S. 10-year bonds.
Right.
Now, one more important kind of, to set this chart up, there is a negative correlation between interest rates in the stock market. And so you have to invert that data. That white line is inverted.
Right. So just bring that back, control room, even though one of these lines is mislabeled on the index, but we can verbally explain it. So viewers will, which line is inverted? As
Okay, the white line, again, U.S. Treasuries is inverted. So last year, the Fed was hiking interest rates. The U.S. 10-year went up. Right? It went up to 4%. So on this line, because it's inverted, it's going down. So as rates go up, weighs on the stock market and the PE compressed. That's why the S&P was down last year. Play that chart forward. Inflation's peaked. The Fed should be maybe imminently stopping to hike rates. The U.S. 10-year could continue to drop a bit more. That should lead to an expansion of the PE. In our market outlook this year, we said that the lower interest rates is going to lead to an expansion of the PE. Stocks are going to be up. Well, here we are 4 months into the year, bang on. We'll see if this continues. So this is the most important thing, is getting these rates to come down a bit, good for the stock market. And then, as I said earlier, next year is where you get the economic rebound. That's when you get earnings. This is why I'm telling clients, I don't think it's just 1 year. I think we have a couple of years of upside in the equity markets.
Thanks a lot.